Global Chief Market Strategist with ATFX. Let's take a look at the markets. We're seeing mostly action in the Australian dollar out of the majors. Let me show you how that looks like. It's related to Chinese data overnight not being too good. So you can see here how the Aussie dollar is under pressure. Euro dollar and GBPUSD is pretty much trading sideways. Aussie dollar, Australian dollar yen is as well slightly lower. Little bit of risk aversion, but not too much. If you look here, the DAX is pretty much unchanged. S&P 500 as well, and the Nasdaq 100. So not too much activity so far, but we're seeing again a little bit of risk off, a little bit of pressure on the Aussie dollar, a little bit I think in the dollar yen, and also in the dollar Swissy. So a bit of a slightly risk off, but maybe mostly in the currencies. Nothing really going on in gold, and nothing right now going on in stock markets. So let's begin then, and we'll begin with the boring bits. That's always easier. And EURUSD, it's easier because nothing has changed. It's been the same outlook here for weeks, more or less. So the trend is bearish for the 112.65, and I continue to be bearish. Yesterday, the Deputy Prime Minister of Italy, Salvini, said that Italy is ready to break the EU fiscal rules to improve the state of the Italian labor market. So they're happy to spend a bit more and break those rules if that's what they need. And that's obviously something that the markets don't really want to see here. They want to see unity, because otherwise what happens is, as people start to talk about the breakup of the EU, well, you heard this many times before, and that could sort of come and play again. I don't think that's really going to happen though, but obviously that caused the euro to trade a little bit lower to the benefit of our markets, and I think that we could potentially go down to 111.50 and 111.30. So I think we can go down slightly, but again, it's going in a very, very slow speed, so I don't really think this is gonna be nothing really for us to do here. As for the GBP versus the USD, so we said a few days ago if we trade below 129.65 that we can reach 129. We did that, and we're now relatively close to 128.64, which is the low down here, and I think the market could potentially start to bottom out here. Obviously, we're still dealing with a bit of a downtrend. You can see here how the market is trading lower, and for now the trend is bearish below 129.65, and I think it might go up and then probably lower again. But if you look at it from a daily chart, the price action is getting quite compressed, and we're really relatively close to the low here. So I would anticipate this to narrow down further, and then maybe early next week or something potentially bottom out and head back to the middle of the range. If I'm wrong and we take out 128.64, I think we could trade down to the next level. And here, when we're in these situations, it's better just to wait and see. It's better to start to operate and trade when the market is bottoming out properly, I think, or alternatively when the market breaks down. Or you can do what I usually do, and markets like these ones, I just ignore them until we have a breakout. That's usually easier. And the Aussie dollar is one of these. The Aussie dollars, had been converging, as you can nicely see here, and the market traded lower on the 13th of May. And I was actually short for a while yesterday, but pretty much closed out a break even because the trend didn't have enough momentum. But it looks like the market is now moving lower, and it's fair to assume that we'll continue to move lower because we have now this descending triangle has now started to trend lower here, and I think we could maybe go down to the flash crash low eventually. And as for the pattern, it suggests we can go down to 66.17. So yeah, instead of trading something like trying to find that low there and sort of go trade back into the pattern, as one can do here if you want to. Again, I think prefer just go with the flow. Most of the time we're gonna get it wrong, but when we get it right, we win quite a lot. And most of the time as well, at least for me and my own trading, I'm able to reduce my stop loss quite significantly. So the losses are not that big either. Here's the dollar versus the Japanese yen, and the market remains bearish for now. It's not a top quality pattern at all, but the market traded below 109.70. So we had the break here a few days ago, and then we moved down, and now we're going upwards. And as long as we're below 110.11, I think we can go down. There's no secret or magic here. It's just repetition. You see, this is a bearish pattern and bearish trend. The risk reward ratio is set up for us to help us, because the pattern suggests we can go down to this level here. So that would be, if we were shorter here, as we talked about yesterday, it would be a 2.51 times risk reward ratio. So for these sort of short-term setups, you won't necessarily see the results of the 1 or 2 trades. It doesn't work like that. It's doing maybe 100 trades, and then after that you see some sort of pattern, and going with the trend like this should result in a positive pattern, or profitable pattern, really. So that's all I can say here. There's no magic. It's just following the rules, really. Very, very straightforward. It's a little bit like when you go to a casino. If you play something like roulette, you can either bet on black or red, and then they have usually the green number, and then I think they have something else. So it's not 50-50 that the house is gonna win, or the gambler is gonna win. There's 1 or 2 of those figures there where, or those little slots where the house would win. And then I'm not an expert on the game, but I know there should be probably some other rules as well, on payouts and things like that. And then of course, they play with a guy. Maybe a guy comes in and he wins, but then he might play like 100 times, or whatever, and he would slowly lose and lose and lose and lose. But it's the same technique here. We need to play 100 times or more to start to see a sustainable pattern. Unless, of course, you're doing some very, very specific setups like long-term investing, where you, for example, when Bitcoin was at the lows, you could have said, oh, well, I think Bitcoin is going to go much, 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 much higher. Or for example, when stock markets are low, you're going to say this is going to go much, much higher. Or if there's a special company you like, you're going to say this is going to go much higher, much lower, sort of depending on what you want to do. And then you just hold, you do maybe 4 bets a year, 5 bets a year at most. And then if nothing happens for 6 months, you don't care, because you did your homework and you think it's going to go upwards. And obviously during this period, the volatility what you're holding can be up with 10% or up with 10%, but it's a different sort of investing, and that's more longer term. But what, for the purpose of what we're doing here, is this. And the benefit of doing something like this is actually that instead of, there's both good and bad with everything, right? Like for example, like Warren Buffett. Even Warren Buffett, if you look at the share price of his company, it's had some significant drawdowns, I think like 40% or so. Again, he doesn't trade, Warren Buffett. So what he does, he just buys corporations and companies that he likes, and then his share price will go, has been going up and up since he started. But he will have sort of massive down moves, and then it will be low for like 2 years. So, and then it goes back up to the highs again. It's something special as well, because everybody loves him, and that itself, I think, has a positive impact on his account. Now, the alternative, again, as I was saying, the longer term investing would be, you buy Bitcoin, and then Bitcoin might be lower for a long period of time. So you have like no negative returns or high volatility, and then eventually sort of goes up like that, and then it's gone like a year, and the market is up. Say it's gone like a year, actually, you close here. So you're up with, I'm just giving you some figures here, like 20% here, and then you'll do that with different shares. Now, if you do it a good and nice portfolio, you might necessarily not have something like this. Maybe if you're lucky, you'll get it like that. And I guess it is possible, but not very, very easy. And then what we're doing here is that we're trading short term. So we try to add a little bit of profit every day to the account. And obviously, we can sometimes have these moves without no problem. But the idea would be limit all the losses, keep them small, and then create a return that is still upwards, but not necessarily as volatile as the long-term stuff. You won't see your portfolio down with 20% one day and then up with 20 the day after. You know, you're gonna see should hopefully take longer periods of time, these drawdowns. So there's a different style of trading. It's more like hedge fund style. And again, these sort of analysis, this sort of trading here is just aligning up the trend, aligning up the risk reward ratio, and then rinse and repeat. Just do this day in, day out. And this is the problem so many times with trading. People don't understand this. So what happens is that they can't follow through on the system. Number two, they trade with too much risk. So they risk too much per each individual trade. So when they have a string of losses, which everybody's going to have, then they lose too much. They get nervous, and then that causes more problems. So and the only way to get around that is actually just to trade with lower risk and mathematically trying to figure out what's like a good amount of risk per trade. And actually, this is something we're going to talk about in a webinar coming up, or seminar that we're going to do here in London. It's not going to be a webinar, it's going to be seminar in London next week on May 22nd. And I put a link on that in the chat box. If you're London based or going to be in town, we're going to have an event. You just need to sign up and register. We have, I think, about 15 people registered, more or less. So that's the capacity. But if there's a lot of people signing up, then we might do something the day after. And if someone cancels, of course, then you can just join on and take the slot there that person couldn't use. It's a free event. It's arranged by ATFX offices, and we're just here at the next to the Bank of England and Bank Station. Okay, let's move along here. Gold prices. So gold prices are bottoming out. So we talked about buying here at 1293.99, so 1294, and the market pulled back to support, and it's now moving upwards, and it's looking good. I think it could be a bit too early to reduce stop loss orders, but when this starts to go up towards the high, maybe 1,302, I think at that point I'll probably take the trend finding level, put it here. But it's looking good. You guys have two lows, pretty much same levels. It might swing lower as the US market opens, but it's looking good right now. This is crude oil prices. So crude oil prices, we said people probably gonna sell at 61.95. That happened. So people sold here. We had a little bit of an overshoot to 62.10. So that's 15 cents. So it's very minimal. And I think when we take out 60.62, I think at that point the market is probably going to drift lower. And I think at that point we could take the trend finding level and put it up here. Effective loss risk on this one would suddenly be minimal. From an initial loss or potential risk of 138 cents, the effective risk would be 14 cents. So suddenly the risk reward ratio here, if we would reach a target, the effective risk reward ratio on the trade would be 26.43. And again, that's what we do in these trend trading, or at least I do. Sometimes the market's going to go straight up, I'll lose the whole thing. But on average, I'll be able to reduce it maybe with 30% or so. So we usually have like that, it'll move. So to give you an idea, I usually risk 1%, 1.5% of my money per trade. But the effective loss is 1%. So that's a third less. And I think it's even possible to reduce that even further. And as soon as you reduce the stop loss or reduce your average loss, for example, the initial risk reward was 2.7. And then when you are able to reduce it slightly, if you actually keep it to the target, your risk reward ratio now becomes 4.6. And that's the end result that matters. So a lot of people, what they do wrong is that they try to do from the very beginning have a very good risk reward ratio. So they try to sell here, have a very tight stop loss. So it looks good on the initial, but because if you're too tight to the price, what's going to happen is that you're just going to get stopped out prematurely. And you don't want to do that. You want to allow the position to have enough time to sort of reverse, and then you just reduce it, and then your effective average loss becomes smaller, and you get that risk reward ratio. even if you didn't have an optimal risk reward ratio to begin with. All right, so this is the S&P 500, and the market is slightly up. I mean, it's up from yesterday, from the lows. We sort of reversed here almost. I think though that this could probably have another go to the upside. I think it can go up again and then potentially trade lower. That's what I will look for. In the German DAX as well, you know, starting to look more and more like a head and shoulders with a big head and left and potentially creating that right shoulder. Ideally, it actually goes down again and then swings up and then takes out the low. That would be the ideal situation, because then you have a more well-defined right shoulder. So here I continue to be bearish, but as always, there's always a level really where you need to give up on your bearish view, and that's for me 12,224. As long as you have sort of some sort of a strategy, well-defined rules where to put stop loss orders and take profits, the numbers really just come by themselves. I like to evaluate myself. I look at my trading relatively frequent as everybody else, but I don't get worried. You know, if the trading is not going good a particular month. I mean, I'm not even worried. I mean, it all depends on the drawdown, right? So end of years usually where if I really want to do something and I say, okay, I had some good returns, that's when I start to pull money from my account. I don't pull money from my account every week or every month or every quarter. Rather, I pull the money by the end of the year, because the markets are many times unpredictable and random, and that means that the outcome of the system as well is going to be unpredictable and random. But we know that if you have a long enough investment, or not a long investment horizon, but long enough if you just evaluate your years on an annual basis or quarterly, then you can see some patterns that hopefully should be profitable. Okay, I think we're gonna wrap things up unless you guys have any questions. So we have Andrew Miles here. Good morning to you, sir. And we have as well Nikos from Greece and Marvin as well. Good morning to you guys. Thanks so much for joining me this morning, and thanks so much for you join me here usually in the morning, so I really like that. We're having a decent amount of people here today. I'm really happy about that. I have 14 people watching right now. We are, however, having not too many likes here. So if you do like the video, if you do like to tune in, don't forget to like the video. I think on average right now we have about 80 views per day, which is awesome. Like total views, and I really want to thank all of you guys that have been liking the videos and sharing the content as well. It's very straightforward to like it. You click here, and then you can also click on share, and you can share the link. You can share to Facebook, Twitter, and a bunch of other social media platforms here as well. Don't forget to check out the home page, and ideally what you do is you actually subscribe to the videos. Why? Because there's 2 videos I do every day. Not every day, but pretty much every day. I do a video called Front Row, which are these ones where I'm in front of the office, the London office here, at the lobby. And I try to address things that I haven't covered in the morning videos. And I try to go slightly more in depth, but the videos are not very long. It's like 4 minutes or so. So you have the front row videos, and then you have the morning briefs. And the morning briefs, the way the system is set up here at YouTube, is not necessarily ideal. But when you come to the homepage, which is actually YouTube ATFX UK, that is the new link. Then usually if I'm live at 9:30 a.m., I will be live here. And then if I'm not live, the video goes here in under the morning brief. And if you ever miss out, you can just go here. You can, of course, if you want to, subscribe to this particular playlist as well. But I suggest you check out both, because, for example, like the GBP yen idea that I traded myself, and Aussie dollar yen, like I shared those last week, like 6 days ago. There's the Aussie dollar trade idea. as well. I shared that already 1 week ago. There's many different things here that I've been covering here that that can help you. We have also trading education. I haven't produced this myself, but it's made by a team that have been doing trading education for a good numbers of years. So if you feel that you want to maybe learn something new, or just maybe you're totally new to the market or so, you can check this out. And here at the bottom, when I am at CNBC, I usually record. This is like the behind the stage, or behind the scene, really, because I'm being interviewed here. But this recording goes out in Arabic. I don't speak Arabic, but they dub the video in Arabic. And what happens is that it's not really useful if you're not speaking Arabic. But what I do is I record my answers, and then I just cut the video, and you can listen to them here. So all of these things, if you subscribe to a channel, so let me show you. Let's go to, say, CNBC today. So this is CNBC, their channel, and you can see here up in this right corner, you can click on that button, subscribe. If you click on it, and then you click on that little bell button, you can subscribe to the channel here at ATFX. Now I'm showing you this on CNBC just because I can't subscribe to my own channel. Let me actually see here if I can use a different browser. Yeah, so you see this, you have the subscribe button, and then that little bell shows up. Okay, I think we're gonna wrap things up. If you guys have any questions, let me know. I'm available via Twitter at AlexFX00. You can see that little line there. And don't forget to check out the Eventbrite and the webinar we're having here. So again, it's going to be in our London offices. So that same video here, you can see here, going to be in that boardroom. So we can fit maybe 10 people, 15 people there. So as far as I know, it's pretty much fully booked for May 22nd, but if there's a high demand, we might create an event for the 23rd, and if someone cancels, we might you might be able to take their spot. So it's very straightforward. Just go to Eventbrite, which is this page here. You click on register, and you'll get the invitation and a phone call from David Berg. Now David Berg used to be with eToro, and before that with a few bunch of other brokers, and he's the head of the retail desk here at actually all traders desk, all English sales here in London for ATFX. Okay guys, thanks so much for watching. Don't forget to like the video, and I'll see you guys tomorrow same time here at the ATFX YouTube channel. Thank you.